Welcome, viewers. In today's video, we delve into the captivating saga of Silicon Valley Bank's recent crisis, unraveling the complexities that led to its unprecedented challenges in 2023. This real-world financial tale serves as a valuable lesson for investors and individuals alike, shedding light on the importance of diversification, industry concentration, and understanding a bank's investment strategies. Let's dive into the Silicon Valley Bank crisis and extract insights that can shape our understanding of the ever-evolving financial landscape. Don't forget to like, subscribe, and hit the notification bell to stay updated on our insightful content. Causes of Silicon Valley Bank's trouble. In the early months of 2023, we've witnessed three notable bank closures, with two being failures and one a closure. Silvergate Bank, based in San Diego, initiated the trend by announcing they couldn't meet regulations due to heavy involvement in banking crypto businesses. The intricacies of Silicon Valley Bank's troubles unveil a story of a financial institution deeply entwined with the tech industry. While Silicon Valley Bank's primary focus on tech companies provided lucrative returns during prosperous times, it also exposed the bank to the inherent volatility of the sector. The bank's business model thrived when tech companies flourished, boasting robust cash flows and healthy balances. However, the fragility of this model became evident when the tech industry faced challenges. Many of SVB's clients, particularly startups and smaller tech firms, operate on thin profit margins or even at a loss, relying on constant capital infusion for sustainability. The economic landscape shifted in 2022, prompting a slowdown in deposits from tech companies. This shift was exacerbated by rising interest rates as the Federal Reserve aimed to counteract inflation. The tech sector, known for its cyclical nature, witnessed a tightening of funding and reduced access to capital, impacting the very clients Silicon Valley Bank heavily relied upon. Additionally, SVB's significant concentration in 10-year Treasury bonds, while considered a safe investment, turned into a double-edged sword. The decision to invest heavily in these bonds, while seemingly conservative, left the bank vulnerable to interest rate fluctuations. As rates increased, the market value of these bonds diminished, resulting in substantial losses for SVB. The bank found itself caught in a challenging position, a portfolio heavily exposed to an industry experiencing a downturn, coupled with investments that suffered from a rising interest rate environment. The need to cover deposit withdrawals, coupled with losses incurred from selling devalued bonds, created a perfect storm for Silicon Valley Bank. Moreover, the revelation of SVB's $1.8 billion loss on bond sales on March 8, 2023, triggered a loss of confidence among investors. As news of the losses spread, tech CEOs and investors began urging each other to withdraw funds from the bank, fearing further financial instability. The government's intervention was crucial in preventing a complete collapse. They backstopped the uninsured deposits totaling $151 billion to maintain confidence in the financial system. However, it's important to note that this is not considered a bailout, and stock and bondholders remained uncertain about their returns. Lessons for investors. Reflecting on the recent events surrounding Silicon Valley Bank offers crucial lessons for investors, guiding them in navigating the complex terrain of banking relationships and economic fluctuations. Diversification emerges as a central theme in these lessons. While having accounts at larger banks like Bank of America and Wells Fargo is common, the importance of maintaining relationships with community banks becomes apparent. Community banks often exhibit diverse portfolios, catering to various industries such as law, healthcare, real estate, and pharmaceuticals. Unlike Silicon Valley Bank, these banks don't rely solely on one sector, reducing vulnerability during industry-specific downturns. One critical aspect to inquire about when evaluating a bank's stability is its concentration in a specific industry. Silicon Valley Bank's downfall illustrates the risks associated with banking institutions heavily aligned with a single sector, especially one as volatile as technology. Investors should question their banks about the industries they serve and assess the potential impact of economic shifts on these sectors. Another essential consideration is understanding a bank's investment strategy. In Silicon Valley Bank's case, their heavy investment in 10-year Treasury bonds seemed prudent until interest rates rose. Investors should inquire about where their bank places surplus cash and evaluate whether the bank's strategy aligns with prevailing economic conditions. Furthermore, questioning a bank about its cash ratio over deposits and loans provides insights into its liquidity. Understanding how well a bank can handle a sudden surge in deposit withdrawals is crucial. The ability to cover deposit outflows without resorting to fire sales of assets can prevent a cascade of events similar to what occurred at Silicon Valley Bank. The distinction between insured and uninsured deposits also becomes pivotal. While the FDIC insures deposits up to $250,000, many businesses, especially in the tech sector, hold deposits far exceeding this amount. Investors should be aware of the uninsured portion and assess a bank's ability to handle withdrawals from large depositors without jeopardizing its stability. In conclusion, the Silicon Valley Bank crisis serves as a stark reminder that the financial landscape is dynamic and prudent decision-making involves meticulous inquiry and diversification. By fostering relationships with a mix of banks, questioning their practices, and staying informed about industry concentrations, investors can position themselves to weather economic storms and make more informed financial decisions. Thank you for joining us on this deep dive into the Silicon Valley Bank crisis. We hope you gained valuable insights into the intricacies of banking, investing, and navigating economic shifts. If you found this video informative, give it a thumbs up, share it with your fellow investors, and don't forget to subscribe for more content. As we continue to explore real-world financial events, remember to stay informed, diversify wisely, and make sound financial decisions.